Why don't you just buy the S&P 500? Do you like to drip, meaning do you use dividend reinvestment programs? Could you suggest a few simple, high-income ETFs to retire on instead of managing a whole portfolio? These are some of the questions I'll answer in today's Q&A. So why don't you just buy SPY? I've received a few questions along the lines of SPYI is up X whatever percent this year, that beats your portfolio, or SPY goes up 9% per year on average and it's impossible to beat that. The short answer is, I did hold SPY when I was working. I'm just not a fan of it in retirement. SPY is a great long-term growth investment. Same goes for VOO, QQQ, and the other low-cost index funds that track the S&P 500 and the Nasdaq 100. The issue with this question is that we're playing two different games. If you're playing a game called accumulate the biggest pile of assets possible, then yes, buy an index fund. It works well. As soon as I retired, that game doesn't work anymore. Actually, it would work at the moment. During a bull market, you could just sell some of your portfolio as it rises in value. The problem comes during a bear market. In retirement, the game is called pay your bills and stay ahead of inflation, and that's a different game to make a big pile of money. If you want to play the retirement game with SPY, you're going to have to sell some of your portfolio every month or quarter or year to pay your bills. Let's say you start with 5,000 shares of SPY on day one of retirement. If you follow the 5% rule, you'll sell 4% of 5,000 shares in the first year. That's 200 shares, and that leaves you with 4,800 shares to sell before you die. But not necessarily. If you're unlucky enough to retire during a bear market like 2022, 200 shares isn't going to cut it. The market was down 19% that year. You're going to have to sell more like 245 shares to pay the bills. And that sucks. But don't worry, the market averages 9% per year. And you've still got 4,755 shares to sell before you die. If you sold 200 shares per year after 25 years, you'd have 0 shares left. Nothing. The good news is that the shares will appreciate at 9% per year on average, and bear markets don't last forever. So as the market value goes up, at some point you'll be selling less than 200 shares per year. So it'll last longer than that. If you choose to play the game that way, you just need the market to increase in value faster than you spend the money to live. Statistically, there's a very high probability that it'll work. That's why it's popular. However, psychologically, it attaches your emotional state to the market. In other words, you're happier when the market is up because you can sell fewer shares to pay for living expenses. And you're stressed when the market is down because you have to sell more shares at a lower price to live. And you only have a limited number of shares to sell before you die. Now, while you have a paycheck, none of this really matters. You can deal with a bear market the way many of us do by simply not looking at your brokerage statement. All those red numbers are just depressing. And if you're a good investor, you just keep pumping your savings into the market, and in the long run, your portfolio will recover and you'll accumulate a big pile of money. So there are many ways to deal with this problem of making your nest egg last longer than your spending does. For example, you could buy long-term treasuries, but they're not going to pay 9%, more like half that. So a 60-40 stocks and bonds portfolio is going to return closer to 7% than 9%. And those treasuries have to be laddered so they mature when you actually need or want the cash. I've chosen to play the retirement game using income investing. When the market has a great year, my total return will be less than the S&P 500, and I'm okay with that. It's not a competition. When the market is down, I'll still receive the income I need to pay my bills, and I'll use some of that income to buy more income investments at lower prices with higher yields to further boost my future income. That's what works for me, but I'm still open to other ideas. If anyone is selling their SPY or VOO to pay for their retirement and didn't feel stressed during the 2022 bear market, feel free to share your strategy in the comments below. Perhaps you have a hybrid of income and growth strategies that you adjust based on what the market's doing. There are plenty of different strategies that work. Speaking of retirement, if you're new to the channel, I retired in 2017, and that's when I got serious about researching my investments in greater depth because now they pay for everything. I mostly focus on stocks and funds paying consistent yields of around 8 to 12%. And if you want to see my portfolio along with updates, there's the link in the description and it's free. Question 2 asks if my dividends grow, and I think inflation has made this an even more important topic. I address the inflation problem in 2 ways. First of all, some income investments do grow their payouts. Here are some examples from my portfolio. HESM has grown its distribution from 27 cents a quarter in 2017 to its most recent payout of 65 cents in May of 2024. ARCC has grown its distribution from 30 cents per quarter in 2005 to its most recent payout of 48 cents in June of 2024. And they've also paid some special distributions, which make the distribution chart a little bit confusing, so I've highlighted those in a different color. ARCC had one cut after the 2008 GFC, but it did eventually recover from that. These distribution charts came from Snowball, but I mostly use Snowball to keep track of my current and future income. I can visually rank my portfolio by current yield, see yield on cost, and know exactly when the next dollar will land in my account. There's a link in the description for a free trial and a discount. UTG has grown its distribution from 9 cents per month in 2004 to its most recent payout of 19 cents, which it already declared in advance for September of 2024. There are more lines on this chart because they pay monthly, and once again, those big spikes are special distributions. That income growth is nice, but I don't rely on it. My primary way to stay ahead of inflation is to reinvest some of the income. For example, QQQI yields 14% and SVOL yields 16%. I don't expect any income growth from those funds, but if I reinvest a portion back into the portfolio, then the income will continue to grow. I'm also reinvesting to mitigate risk. SVOL's 16% yield isn't risk-free. If I spend 8% and reinvest 8%, that's more than enough to cover inflation. It also creates extra income for a rainy day. So what would a rainy day look like? Well, perhaps one day there'll be a massive VIX spike and SVOL's call option hedge will only cover a portion of the losses. If I've invested a chunk of that SVOL yield into other income investments, then I've built a buffer of extra income to mitigate that risk. So in summary, yes, I think income growth is important. My portfolio currently yields about 10.8% and I don't spend all of that. Question 3 is, do you drip? In other words, for the income that I do reinvest, do I buy more of the same investment that produced the income? The answer is no. Automatic reinvestment means you pay whatever the price happens to be on that day. I have over 30 stocks and funds, and at any given point in time, some will be more richly valued than others. For investors that don't like to spend much time managing their portfolio, drip is better than letting distributions just pile up in a cash account for long periods of time. I actively manage my portfolio, so at least once a month, I'll take the cash that I want to reinvest and buy whatever presents the best opportunity at that time. It could be adding to an existing holding or buying something completely new. It's shopping for income, which is my favorite kind of shopping. Question 4 asks about how to time the transition from growth investing to income investing, and this would apply to someone who had a lump sum come into their account, for example. Is it better to sell everything in one day and buy a whole new portfolio or transition slowly? Well, the success of either method depends on timing and luck, so I think this is more of a psychological question than a financial question. There's no right answer, but I opted to do it gradually over a period of months, and there are a couple of reasons for that. Number one, there's a learning curve. If you suddenly transition from being a growth investor to being an income investor, there's a lot of pressure to learn about a whole new universe of investments, and there is a lot to learn. I've listed a few examples here. I knew about some of these when I retired, like REITs and closed-end funds, but I didn't really know much about preferred shares or business development companies. You can get all the basic financial data on these from free websites like Yahoo Finance, but that doesn't really teach you how these investments work or make a case for whether to buy or sell them, which is why I use Seeking Alpha. I don't always agree with the Seeking Alpha analysts, but I like reading the arguments for and against and then just coming to my own conclusion. If you haven't used it, there's a free trial and a discount linked in the description. So I don't think you want to rush that learning curve and buy the wrong thing because you have a big pile of money that's just burning a hole in your pocket. The second reason I decided not to do it all at once is that it sets you up for a win-lose outcome, and this is the psychological part. If I bought an entire income portfolio on January 1st and then the market tanked a week later, I'd feel like I lost. Or if the portfolio had a nice bump in the first month, I'd feel like I was really clever, when of course I was just lucky. By spreading out the buys, the ups and downs of the market were much less obvious, and I didn't feel like I won or lost when I was making the transition. The last question is asking if there's an easy way to be an income investor. Can you just buy a few ETFs and forget about it? It's a great question because it is possible to be a successful growth investor with only a few funds and almost no research or management. You can just invest regularly in SPY and QQQ, wait for 30 years, and you'll have a big nest egg. It would be nice if income investing was that easy. I think it would be a lot more popular if it was. If I had to build an income portfolio with just, say, 5 funds, then well, the list would start with funds like SPYI because it converts a portion of the S&P 500's gains into a yield of about 11 or 12%. Maybe JEPQ or QQQI to do the same thing, but for the NASDAQ 100. PBDC to get some exposure to BDCs in the private lending space. You could throw in PFFA for the stability of income from preferred shares, and probably a REIT or two, something like RQI or RLTY. Even though funds like this are probably a good way to start an income portfolio, and you got to start somewhere, I think it's too risky to put 20% of your net worth into 5 funds and then forget about it for a couple of reasons. First of all, I want more diversification than just 5 funds. Those 5 gave me no exposure to corporate loans, corporate bonds, CLOs, MREITs. I also would have missed out on the consistent income offered by midstream partnerships like HESM. Maintaining a portfolio that produces consistent income requires enough diversification so that no one investment can cause you headaches. I just don't think 5 funds is enough to achieve that, at least not for me. The second issue is that unlike growth investing, income investing isn't set and forget. For example, preferred shares, not such a great investment while interest rates are climbing, but BDCs make extra profits when interest rates are rising. My portfolio doesn't have a lot of turnover, but I do make some adjustments based on what's happening with the economy. So if you're not willing to fully understand each investment and how it's affected by the economy, I don't think income investing is a great idea. Some people are better off just finding a financial advisor, buying annuities, or some other way of outsourcing their investments. That means more fees and probably lower returns, but it's better than blindly buying the wrong investments just because you saw someone else buying them. Income investing is something I think every retiree should be aware of, but I don't think it's something every retiree should be doing. Like most things, it just works better if you enjoy it. That's 5 questions covered. If you want a brief summary of each investment in my portfolio, here's a playlist that covers most of them. My portfolio does change over time though, so for the current list, click the Armchair Insider link in the description. More Armchair Income coming soon. Armchair Income.